24% of homeowners have mortgages with rates of 5% or higher, up from 10% 2 years ago. What does this mean for the housing market? I'll break down how this shift in mortgage rates is shaping the real estate landscape and what it means for buyers and sellers. Picture this. Nearly a quarter of homeowners are stuck with higher mortgage rates. That's a big change from just 2 years ago. But here's the thing. Most housing reports don't tell you the whole story. They focus on home sales, but I'm going to show you something different. In this video, we examine the housing market through the lens of mortgage data. This approach provides unique insights not found in typical housing reports. And let me tell you, there are some surprising revelations about the housing crisis that go way beyond interest rates. Stick around because what I'm about to share might change how you think about real estate in today's market. Now, let's dive into the current mortgage rate landscape. Since 2022, we've seen a significant shift in the market, with over 4 million loans originated at rates of 6.5% or higher. That's a staggering number, and it's reshaping the way people think about home ownership and refinancing. But here's where it gets really interesting. There's a peculiar phenomenon happening right now at the 7% mark. We're seeing a huge spike of about 690,000 loans with rates just below 7%. Now, you might think this is because of some financial advantage, but it's actually more about psychology. People just feel better about seeing a 6 at the start of their mortgage rate instead of a 7. It's not rational, but it's human nature. This psychological barrier is likely playing a big role in future refinancing behavior. Homeowners with rates just below 7% might be less inclined to refinance even if rates drop slightly because they feel they've already secured a good rate. On the flip side, those above 7% might be itching to refinance as soon as rates dip below that magic number. Right now, you might be thinking, why do I care about refinancing? I want to know about buying or selling a home. Well, just hang in there. This is the background data that we'll tie together to provide you more insight by the end of the video. Now, let's talk about a group that's really making moves in this market, VA loan holders. We're seeing a dramatic increase in VA loan refinancing, from less than 10% to over 30% of all rate and term refinances. That's a huge jump, and it tells us a lot about how savvy borrowers are adapting to the current market. These VA refinancers are typically early in their loan terms, averaging about a year into their 30-year mortgages. They're not waiting around. They're taking advantage of streamlined refinancing programs to lower their rates significantly. On average, they're saving about $230 per month. That's real money back in veterans' pockets. What's driving this surge in VA refinances? It's the combination of streamlined programs and significant rate reductions. Veterans are able to lower their interest rates without jumping through too many hoops, and that's making a big difference in their financial lives. If you've been following me for a while, you know I often discuss the data and information gleaned from the mortgage market because so many videos on YouTube are made from fearmongers who want to pump up concerns about foreclosures. Yet market conditions are completely opposite of what you would expect for an impending foreclosure crisis. If you're not a subscriber, please click the thumbs up like button and subscribe now to get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. Now that we've explored the rate landscape, let's shift gears and look at the bigger picture. You might think interest rates are the main culprit behind the home affordability crisis, but there's more to the story. Let's dig into some other factors that are shaping the market in unexpected ways. First, let's discuss mortgage applications for home purchases. These numbers tell us a lot about buyer behavior and market demand. Over the past year, we've seen some interesting trends. Despite rising interest rates, application volumes have remained relatively steady. This suggests that buyers are adapting to the new rate environment, but it also hints at some underlying issues in the market. One of the biggest challenges right now is housing inventory. Simply put, there aren't enough homes on the market to meet demand. New real estate listings have been slower to hit the market than in previous years. Why? Well, some of it comes down to something we talked about earlier, refinancing. Here's the thing, when homeowners refinance to a lower rate, they're essentially locking themselves into their current home for several more years. Think about it. If you've got a brand new mortgage, is it likely you'll be moving next year? Probably not. The decision to refinance is a data point that collectively identifies the likely upcoming supply of homes in the resale market. And right now, people are locking in. It's reducing the supply of homes for sale and, at the same time, reducing demand from potential move-up buyers. Now, let's look at home prices. The ICE Home Price Index gives us a good snapshot of what's happening across the country. Despite all the talk of a housing market cooldown, prices have remained surprisingly resilient. In fact, in many areas, they're still moving higher at historically normal rates. This combination of steady demand, low inventory, and rising prices is creating a perfect storm for affordability issues. But here's where it gets really interesting. The traditional metrics we use to measure affordability, things like median home price to median income ratios, might not be telling the whole story. There's another factor at play that's having a massive impact on home affordability, and it's not what most people think. You see, while we've been focused on interest rates and home prices, there's been a shift happening in the background. It's a change that's been gradual but profound, and it's reshaping the entire landscape of homeownership in America. And no, it's not about foreign investors or institutional buyers scooping up properties. You've probably heard a lot of talk about a looming foreclosure crisis. It's all over the news, with experts warning about rising delinquency rates and a potential wave of foreclosures. But here's the thing. When we look at the actual mortgage data, a very different picture emerges. Let's start with delinquency rates. Now, you might expect these to be skyrocketing, right? I mean, if a foreclosure crisis is imminent, it's because people aren't paying their bills. But the reality is quite surprising. Current delinquency rates are actually much lower than historical averages. In fact, they're nowhere near the levels we saw during the 2008 financial crisis or even pre-pandemic times. So, while the doom and gloom predictions, well, it's easy to get caught up in the short-term fluctuations and lose sight of the bigger picture. But when we zoom out and look at the long-term trends, we see that homeowners are in a much stronger position than many realize. Let's dive into some specific mortgage performance metrics. These are the numbers that banks and lenders use to gauge the health of their mortgage portfolios. And guess what? They're looking pretty good. Foreclosure rates are near historic lows. The number of homeowners who are underwater on their mortgages, meaning they owe more than their home is worth, has been steadily declining. But here's where it gets really interesting. Banks' level of concern about mortgage performance has actually decreased in recent years. Why? Because the data shows that homeowners are in a much better financial position than they were during previous economic downturns. Think about it this way. Most homeowners who bought or refinanced in the last few years locked in at historically low interest rates. They've built up significant equity as home prices have risen, and thanks to stricter lending standards, they're generally better qualified borrowers than in the past. All of this adds up to a housing market that's much more stable than many people realize. But that doesn't mean everything's rosy. There's still a major issue affecting home affordability, and it's not what most people think. You see, while we've been focused on interest rates and home prices, there's been a shift happening in the background. It's a change that's been gradual but profound, and it's reshaping the entire landscape of home ownership in America. So, what is this hidden factor that's really driving the home affordability crisis? Well, it's not about foreign investors buying up properties. It's not about big corporations snapping up single-family homes. And it's not even primarily about those high interest rates we've been talking about. The real culprit? It's a fundamental change in who owns homes in America over the past decade. We've seen a significant shift in the balance between homeowners and renters, and this shift is having a massive impact on home affordability, especially for first-time buyers. So, what have we learned from our deep dive into mortgage data? Well, it's clear that the housing market is more complex than many realize. We've seen how psychological barriers around interest rates can influence refinancing decisions and how VA loan holders are taking advantage of streamlined programs to save money. But the real eye-opener? It's not just about rates. The true nature of our home affordability crisis goes beyond interest rates and home prices. It's rooted in a fundamental shift that happened in the wake of the Great Recession. Significant changes were made to mortgage lending standards in the U.S. to address issues related to credit risk and housing market stability. One notable shift occurred in 2010 when the Federal Housing Administration, also known as the FHA, began requiring a minimum credit score of 580 for low down payment home loans it was willing to back. This was part of a broader effort to tighten credit availability following the financial crisis. Just 2 years later in 2012, many mortgage lenders had increased their own minimum credit score requirements to 640, further restricting access to credit for borrowers with lower scores. This tightening of credit standards effectively ended many programs that were previously available to borrowers with lower credit scores. This seemingly small change had a massive ripple effect. With stricter credit requirements, fewer first-time buyers could enter the market. Builders, seeing less demand for starter homes, scaled back production at the lower end. Fast forward to today, and we're facing a serious shortage of affordable homes. It's not foreign investors or big corporations buying up all properties. They own less than 0.5% of single-family homes. No, the real issue is this mismatch between what's available and what many buyers can afford or qualify for. This shift has reshaped who owns homes in America. We're seeing a growing divide between homeowners and renters, and it's making that first step onto the property ladder increasingly difficult for many. But here's the thing. Understanding these broader market dynamics can actually empower you as a buyer or seller. If you're looking to buy, knowing about these underlying factors might help you approach your home search differently. Maybe you'll consider different neighborhoods or look into alternative financing options. For sellers, understanding this can shape your pricing strategy and explain why some properties sell fast while others linger on the market. For a current overview of the housing market, check out my recent update using Zillow market data. It's factual, timely, and definitely worth a few minutes of your time.